Okay, welcome back to the Retire Stronger podcast. This is episode 6, part 1, where Bill and I are going to talk about tax optimization. So, welcome, Bill. Glad to be back with you.
Hey, John. Good to be here.
Awesome. So, I guess it would be good to start off and kind of explain what we mean by tax optimization and what we're referring to when it comes to retirement planning and retirement income, and how we help our clients navigate those issues. And really, what we're talking about here is the structuring of a client's assets and their income to be the most tax efficient and tax optimized as it possibly can, leading up to and through retirement. And I will tell you, many of our clients come to us with an opinion or a viewpoint that they're really not able to do much about taxes, especially now or even in retirement, when we find that that couldn't be further from the truth. And I think that what we're going to talk about today and in the next episode in part two is a good overview of what we're going to discuss today. That's what this episode will be about. And then in episode two, the second part of this is going to be strategies that we use and how we help our clients become as optimized as possible from a tax perspective during retirement, and especially with regard to how they're taking income and where they're taking the income from. We're going to discuss mainly the overview of this entire topic today. And I guess what I'll do, Bill, is just turn it over to you and let you kind of kick it off and start us off with kind of the first part of this topic of tax optimization.
Yeah, thanks, John. Good to be with you today. And this is something that we spend a lot of time with our clients discussing in our practice. And I think the purpose of today is to give an overview of what we mean by tax optimization. We are not providing any specific advice to anyone on what you need to do
Absolutely not.
inside your plan, but this might spark some interest to figure out, well, is my plan that I have actually tax optimized? What does that mean, and how would I know if it is? And I think the best way to start in that area is kind of what we do with people at the very beginning, and not to promote our services or anything that we do specifically, but it just helps kind of give a picture of what this means. Typically, when we work with families, one of the main things we do over the course of the first couple of meetings is go through a series of scenarios where we're showing them, this is what your finances and your financial picture looks like currently. That might include that you're going to run out of money at some point in the future. And so ideally, we want to identify that well in advance of when that situation could occur, and
Sort of
then
a
figure
sort of a
out
starting point, kind of, Bill. Like, we're kind of helping our clients figure out where they are today.
starting point of where they are today, and are we on a trajectory that is not healthy?
Correct.
That's the key for that first part. Then what would we do to fix that? Now, I will tell you that most advisors will generally come back and say, well, let's just improve your rate of return. Watch, if we improve your rate of return, now everything is fixed. Poof, you're out to 100 years old and you have $1 million or $2 million left over. And by the way, what I'm describing to you, we're going to put in the show notes a screenshot of this so you can kind of see what these outputs look like. And I think something that makes us a little bit different in what we do, John, is that we then take that third step where we take the plan. Okay, now you're not going to run out of money, at least the way it's projecting here, but we've created a big tax problem potentially. What do we do to solve that? Or can we solve it? Is there anything that we can do? And I find, and John, I think you found this as well, many people come to us and they have a number in mind for retirement that says, I need to have X number of dollars. If I have 3 million or 5 million, when I hit age 67, I'll be ready to retire. And my answer to them is typically, well, that might be true or it might not. We don't know. Uh, but ultimately, tax optimization is what it does is it actually plugs the holes in that bucket that you're trying to fill up that are leaking out of the bottom through tax inefficiency. That's really what we find. So that's kind of a picture of what it looks like. check the show notes. You'll be able to see a screenshot of what this looks like, kind of step one, step two, step three. That's a great way to figure out, where am I? Am I optimized, or am I anywhere close to being optimized in all of that? But beyond that, John, we need to talk a little bit about, what is tax optimization? It's a
Sure.
step that we take. It's a step that you should take inside your plan. What is tax optimization? And so what that really is an education that we give to people that displays to them that your money, all of your money, can only exist in the eyes of the IRS in three specific areas.
Correct.
That's taxable, tax deferred, and the third bucket is generally low or no tax, right? Those are the three areas based on the types of accounts that you have that your money can exist. And those three buckets all interact with each other in the sandbox. And the way those interact with each other determines in large part what your ultimate tax picture is going to look like. And so if they're not positioned accordingly or correctly, if they're not balanced correctly, you could be in a situation where you're on a trajectory to potentially overpay in taxes throughout your working years, even, and your retirement. John, did you want to add anything to what I'm
Yeah,
saying there to
which
kind of round that off?
100%. I mean, and to complete that thought that you just gave us, you know, taxes, if not handled properly in retirement, the taxes on your retirement income can cause you to run out of money sooner. It could force you to draw down your accounts faster because you've got to pull more money out to be able to pay your bills, but you also have to pull enough out to pay taxes on what you withdrew from your account if you are pulling that money from a tax deferred bucket. Um, there was a great article recently that I read in Kiplinger, um, talking about how 401k plans and traditional IRAs may not be the best avenue for retirement saving um, going forward. It creates such a bubble for individuals, and we've seen it with our own clients where they have amassed. I mean, you mentioned it a few minutes ago about our clients come in, they say, if I could just get to 2.5 million or 3 million in retirement savings, I'll be set, and I can take the kind of income I need to supplement my Social Security or my pension or a combination thereof for retirement. And I think what happens is that a lot of people do not realize that actually, from our experience, very few retirees actually find themselves in a lower tax bracket in retirement. It's just what we've seen personally in our practice. And I've personally been doing this 25 years, and it's amazing to me that a lot of people think they will be in a lower bracket in retirement. Many folks do not actually have that come to fruition. So if you've got all this money in a tax deferred bucket, if that's where the bulk of your assets are, every dollar you pull out of that, it's never been taxed before. So you've got to now pay taxes on it. So you were talking about the three main areas that the IRS look at with regard to how your money is being treated from a tax perspective. Our job as advisors and your job as the individual is to find the most efficient way possible to optimize those three different areas so that you can pull out income in retirement that will give you the most tax advantaged situation that you can have. And so having too much money in one area can be a problem. Well, having too much money in the tax deferred area can be a massive issue. If you have, I don't think there's too much. I don't think there's a thing as too much money in a Roth IRA. That's not a bad thing. It could, for most folks. So again, all the stuff we're talking about today, folks, we are not giving tax or legal advice. You definitely want to contact your CPA or tax advisor or your legal advisor on these topics and work with a qualified financial planner. If you don't already have one, feel free to reach out to us. We're happy to give you some direction on where you should go. But just remember, we are not giving advice today, especially on your taxes, but we're just giving you things to think about here. But yeah, I just kind of wanted to add on to what you were saying, is that there is a possibility that you can get yourself in a tax bubble and have what has been called in the media before a ticking time bomb waiting to go off, if you do not plan appropriately, for sure.
Yep, couldn't agree more. And before we jump into those three buckets that we referenced earlier, I want to just talk for just a couple of minutes on Social Security and how taxes apply in the Social Security area, because ultimately, when I go through this with folks, this is something that's a bit of a surprise to them. So, something you need to know about your Social Security benefit. Um, we all know that Social Security has had its issues as far as the ability to fund it. We hear about how it potentially might be running out of money. This is not new. The Social Security Administration has had issues in this area for decades. And going back to the early 80s, there was a situation then when the Social Security Trust Fund, if you want to call it that, was potentially going to run out of money. And in a deal struck with Congress in 1983, there were these new provisional tax brackets that were created that apply to your Social Security benefit. So this provisional tax situation works like this. If you want to calculate what your provisional tax would be on your Social Security benefit, the IRS uses what's called provisional income. And here's how it's calculated. They take 1/2 of your Social Security income. So for a household, take a total of your Social Security income and cut it in half and write that number down. And number two, you want to write down any distributions taken out of your tax deferred bucket. John's going to go into the tax deferred bucket here in a few minutes, but that would be pre-tax IRAs, company sponsored plans like 401k, that type of thing at work. Any 1099 interest that is generated in your taxable bucket, any employment income, any rental income, and any interest from municipal bonds. You add all of those numbers together. If that provisional number comes up to under $32,000 a year, then none of your Social Security benefit is subject to the provisional tax bracket. Okay, 0% would apply in that area. If that provisional income number is between $32,000 and $44,000, then 50% of your Social Security benefit will count as ordinary income for tax purposes in that particular year. And then a little bit later in 1993, I believe it was, the IRS and Congress came up with a third bracket, which is the 85% bracket. Any provisional income calculations that are over $44,000, 85% of your Social Security benefit would be subject to taxation. So
And
this is something.
that's for a joint family, a joint filing couple, right?
Correct. And that,
Yep.
this is something when I've explained this to people, I have yet to meet anyone in just under 20 years of doing this that has any idea this even exists. Now, here's the really tricky thing about these provisional brackets. Those numbers, 32,000, 44,000, those were set back in the early 80s, 1983, and they are not cost of living adjusted. They have been the same number for the last 41 years. So just by inflation taking its natural course, more and more people are getting scooped up into these provisional brackets. So this is number one, right? This is the first area where your money, or a part of your nest egg, if you will, something you're relying on for retirement, is subject to taxes that you may not have been aware of. If you need more information on that, and we'll put down in the show notes here as well the breakdowns on those provisional numbers, just so you can see that. But if you need more information on that, talk to your advisor. Go to our website, crownadvisorgroup.com. Contact us. We'll walk you through what that means if that's not clear. Okay, so that's Social Security taxes. Now, I'm going to talk about asset bucket number one, which is your taxable bucket of money. And John's going to go through the other two here in just a minute, because I'm sure you're getting tired of hearing my voice. So I'm going to make sure I go through it succinctly, but also get you the information you need. So the taxable bucket is relatively simple. This is the area where your money is taxable on an annual basis. This could be money that's in CDs. This is money that's in your checking or savings account. That's typically where we see this type of money. A lot of people will use these types of funds for their emergency funds. And so, having too little in this area means that we might need to withdraw from our illiquid investments or other investments that are pre-tax and generate taxes that way. Having too much might mean that we're generating a lot of 1099 taxable income, which could also affect the tax picture. So we want to have the proper balance here. This isn't exact for everyone, but a good rule of thumb is if you have about 6 months worth of your living expenses in the taxable area, that should hopefully provide you with the correct peace of mind, but also the correct amount, so that you don't have to dip into other areas and unnecessarily generate taxes each year in that area. So 6 months is kind of the rule of thumb there, but that does vary for different people on that part of it. So asset bucket number one is the taxable bucket. This, think checking, savings, CDs, things that are taxed on an annual basis. John, would you please describe for us bucket two, bucket three, which is tax deferred, and what we would call the low tax or no tax bucket?
Yeah, absolutely. So bucket number two, as Bill just mentioned, is the tax deferred bucket. So most of our clients, if not all of our clients, are very familiar with this area of where you can place some money for retirement or for investing or for savings. And what we're talking about here are traditional IRAs, your 401k plan through your job or the company you work for. You could also have be self-employed and have either a simple IRA, a SEP IRA. You could work for a government institution, have a 403b. These are all the types of accounts that would fall into the tax deferred bucket. And what do we mean when we say tax deferred? Tax deferred means you put money, earned income. You have to have earned income to contribute to these types of accounts. There are some slight exceptions to that rule. We're not going to get into that today, but if you have questions around that piece of it, please reach out. We're happy to discuss it in more detail. But for all intent and purposes of today's discussion, you need to have earned income. That earned income you can now take and you can deposit into a tax deferred account, such as an IRA or a 401k through your job. And that money goes into that account without having to pay taxes on it. And I want to caution everyone, because that money, as it goes in, that's great. You get a deduction in your income. So if you make $100,000 a year and you put $10,000 into your 401k at your company, that reduces your reportable income down to $90,000. That's wonderful. That's a great thing, and it can help for tax planning right now. But what you have to be careful with, as over time and as the years go by and you continue to put money into this type of an account, it will grow and grow and grow, and you have this large dollar amount of money that's never had taxes paid on it. So when you go to use it and withdraw it for retirement income, now you have a scenario where 100% of those dollars will be considered taxable. And that was kind of what I was alluding to earlier, that you've got to be careful with how much you allocate to these different buckets. And Bill mentioned this as well, because there is a fine line. There's a balance that has to be created amongst the different buckets that we're talking about here. But that's basically what a tax deferred account or a tax deferred bucket would be your traditional IRAs, your SEPs, your simples, your 403bs, your 401ks. Again, assets in these accounts, they go in before being taxed, and when they come out, they are then taxed. One thing to also consider, the rules have changed over the last few years with the Secure Act 1 and 2, and there's rumors that there may be another version of the Secure Act coming out in the near future. But there is a thing with these type of accounts called a required minimum distribution. And when you hit a certain age, I believe the age is 73 years of age right now. Is that correct, Bill? I'm correct on that.
It is, well, by 2031, it's going to be 75. And I think you're correct. It's 73 as of going into next year, 2025.
Yeah, and as of today. So what we're talking about there is the federal government, the IRS, is going to require you to start pulling money out of these accounts in order so that they can start collecting taxes sooner. And that's the objective. So that's a very high level overview of what a tax deferred account would be, or what would fall into the tax deferred bucket. The other asset bucket that Bill mentioned, either very low tax, if not no tax. What we're referring to here is typically something that you've probably heard of called a Roth IRA. There are other accounts or vehicles you could use that could fall into this bucket as well. Cash value life insurance would be one of those buckets, in addition to a Roth IRA. But what we're referring to here is taking money that you've already paid taxes on. So you've already paid the IRS. You've already given your money to the federal government, to the state government, if your state charges an income tax on your income, and you're depositing that money into this type of an account, like a Roth IRA, for example. And that money is now going to grow tax deferred. And assuming you play by the rules of the IRS, and you don't make any mistakes with regard to how you withdraw those funds, there's a very, very high likelihood that you'll be able to withdraw those funds tax free in retirement. This is a great area. This is a great bucket to use for tax planning in retirement. And we'll go into more of that later in episode 2, or the second half of what we're going to discuss on tax optimization. But Roth IRAs and even cash value life insurance can play a really nice role here with respect to getting money into that third bucket. And Bill, is there anything you want to add on to that? I mean, it's pretty straightforward. There's not a whole lot of opportunities in that area. It's very limited, limited area, and that's on purpose. IRS is only giving us a few options on how to get our money into as much of a tax-free scenario as possible.
Yeah, that's correct. And but people might also be thinking, well, wouldn't I want all of my money in tax-free areas? And you have to remember that what we're talking about here is not specifically product driven. This is
Mhm.
process driven. What
Correct.
ultimately you're trying to do to be successful in this area is you want to create multiple streams of tax-free income. But that doesn't mean that you need to deplete all of the money that's in your pre-tax accounts and say convert it over into a Roth. And we'll talk more about that on part 2 of this. That wouldn't be prudent, because you have to remember that John mentioned earlier that most people aren't in a lower tax bracket when they hit retirement. The reason for that is that the four major things that people have, the four major deductions that people have while they're working and raising a family, generally are gone by the time they hit retirement. Um, that would be mortgage interest, your child deduction, retirement plan contributions, and charitable contributions. Those things are typically either minimized or gone by the time you hit retirement. So the ability to hop outside of that standard deduction that you receive is generally gone at that point. Um, but that standard deduction is important because, and we'll get into, like we said earlier, we'll get into this next time, a little bit more advanced part of this. But if you think about it, if all of your money is taken out of the pre-tax area and moved to the tax-free area, well, you still get that standard deduction every year on your taxes. So John mentioned required minimum distributions. What if you could have this structured in such a way where your RMDs, your required distributions, were at or below your standard deduction? Wouldn't that mean at that point that the money coming out of those pre-tax accounts is now essentially tax-free? Well, it's pretty darn close to that. So there are strategies related to this. This is why you want to have the proper balance. You don't want to have all of your money in pre-tax. You don't want to have all of your money in tax-free. But if you balance these things correctly, you can create multiple streams of tax-free income. And in addition, you could minimize, reduce, or eliminate taxes on your Social Security if done correctly. That's why we talked about the provisional income brackets on Social Security as well. I think that's
Absolutely.
kind of the whole point of this, John, is there's balance here. You have to understand how to balance this correctly. That's where the true efficiency comes in this process.
Agreed. And I think that what we should do is maybe cut it off here and save the remainder of the discussion for part 2 of tax optimization. But what I want to do is I want to leave everybody with a little bit of homework. Take a look at your current, setup that you have with your retirement accounts. Take a hard look and an inventory on where your assets right now are sitting. Which bucket are your assets in? Do you have more of your assets in bucket 1, bucket 2, or bucket 3? Or is it well balanced amongst the three? Or are you lopsided in one area? This is something I think that you could do on your own for now. Take an inventory and take a look at how you're currently set up and how you're structured. And then when we come back for part 2 of tax optimization, we'll get into some more ideas and ways that you could potentially improve your scenario if you're in a situation where you're not optimized the way you would like to be. And again, we're here to help. Reach out to us. Go to our website, crownadvisorgroup.com, and feel free to reach out to us. We're happy to answer questions you might have. Shoot us an email, give us a call. schedule some time, whatever you need to do. But I think that's a good place for us to cut it off and stop today, Bill. Anything you want to add before we close?
One more thing, John. If you're the student that likes to sit in the front of the classroom and bring an apple for the teacher, what you really would do here is you would also try to calculate your provisional income on your Social Security based on the brackets down in the show notes there. See if you can figure that out. And if you're not collecting Social Security, this is a great exercise because it gives you a picture of what you might expect in those areas. And then next time, as we mentioned here, we're going to talk about, well, how do I get around the provisional income? How do I set myself up so that I'm not subject to that in retirement? That's going to be part of the discussion for next time. So see if you can calculate the provisional income part of it too. But if you have questions, absolutely reach out to us. We can help you with that as well. And John, I'll let you close us out. Thank you, everybody, for your time, and I appreciate it today.
Absolutely. Thanks, Bill. We look forward to seeing everyone on episode 7, which will be part 2 of tax optimization. So stay tuned. See you soon. Bye bye.